Dan Egan, he's the Betterment's Vice President of Behavioral Finance and Investing, and an old friend of mine. You know, Dan, I often bring you in during dramatic market moments to help sort of calm things down, bring a little perspective. Let's put the adults in the room here. One of the big classic mistakes we always see investors make is trying to time the markets, thinking they know when to get in and get out. And then another one, which breaks my heart, I have seen it many times in my 32 years at CNBC, is selling at bottoms. So remind us what the right way to think about this is, what we're going through right now, and what are you telling your clients at Betterment?
One of the nice things that I've seen kind of over the past 2 decades is this transfer from people having to manage their portfolios themselves, going into brokerage accounts to place trades, even rebalancing trades or your common buy trades, with people investing in 401ks and even automated digital advisors like Betterment. We're seeing much more consistent investing behavior. So far what I've seen through this, it's been a scary period, but we aren't seeing people freak out in any way whatsoever. Everybody who has had auto deposits or 401k contributions set up, that continues to chug on relentlessly. There hasn't been any fear factor there. And additionally, we're seeing very little kind of like defensive movement, even in allocations. So for context, Betterment has 700,000 plus customers. Of those, over the past week, when things started to get scary, we saw about 50 or 60 defensive allocation changes, which is just not that much. Conversely, we saw about 200 unexpected kind of like new novel deposits of people putting money in. So the ratio is still very much kind of like stay invested, keep chugging along. Don't pay too much attention to your investments. This might be different if you're on a brokerage app or a trading thing. But a lot of our customers, they seem to be holding the line pretty easily because they're not focused on doing it themselves.
Yeah. I want to get back to trading in a minute, but you and I were talking last week on the phone about what looks like a slowdown in housing. At least the numbers are indicating that. You had a very interesting point. You noted that withdrawals to buy a house had slowed down significantly on your website. Tell us about that, and what does it mean? Is there signs froth really is coming out of the housing market?
Yeah, one of our favorite goals that customers set up at Betterment is a house down payment goal. It's a bittersweet moment when a client finally manages to withdraw to put the money down on the house that they probably wanted. And we've seen very high activity of those withdrawals over the past 2-3 years for obvious reasons. We're starting to see that reduce quite a bit as affordability goes down, and people aren't not saving for that house down payment, but they're setting higher targets and they're extending their time frame further into the future. So definitely seeing, at least for us, a good thing of people saving longer and for higher balances, but less froth in the market of actually I'm going to pay it right now.
I want to go back. That's interesting. I want to go back to the flow, the trading flows. And one of the things that we've seen this year is there is continuing to be a core foundation of inflows into plain vanilla exchange traded funds. Tell us about your experience. Essentially, it looks a lot like auto deposits to me. This seems to be sort of apathetic to the markets. This is just robo investing, essentially. Are you seeing that right now as well?
I would say yes. I would say they're less short-termist. So let's take a slightly longer time frame. You go back 3 years. Your total return on the S&P 500 is about 40%, I think, over a 3-year period. This is not some horrible thing for your average investor who's invested over the past 3 years. This is not the signs of panic and, oh, I've made a horrible decision. So for people who are investing, and generally we talk about somebody investing for at least 3+ years, and the further out you go, if you're talking about your kid's college education or retirement, these are things where you don't get distracted by really short-term ups and downs in the market because your focus is on something that's 10+ years away. And it makes it really easy to sit through these ups and downs and say, maybe this is more of a buying opportunity than a freak out opportunity. That mindset, that mentality of the money is going to be here for a long term, so drawdowns aren't a horrible thing. It's something unique to investors, not traders.
Yeah. Is anybody buying the dips right now? Do you see anybody suddenly taking large chunks of money, I mean, for a retail person, $20,000, $30,000, $40,000, and just saying, I'm betting on the bottom here? Or is that not happening?
I think what we've seen is that it's already been happening. I think it's been happening for probably the past month or so. People got very used to the idea of buying the dip, it'll rebound quickly, such that all they needed was sort of a 5%, 10% drop in order to trigger that behavior. I think that dry powder has been used up at this point. And the inflows we're seeing are always the more consistent ones, or people who have had an unexpected windfall, money coming in, tax returns, et cetera.
Yeah. Mike, you get the last word here. What's encouraging here to hear Dan talk about is, and maybe this is because the Betterment crowd is slightly older, maybe they've got a little more experience doing this, or maybe they're just listening to Dan more, but inflows are fairly consistent in these plain vanilla ETFs, despite the gyrations that we've seen this year. Tell us what you're seeing and what that tells you.
Yeah, I think it's a combination of things. I mean, you have to kind of break the ETF market between, buy and hold beta strategies that you and Dan were just talking about, and more tactical strategies. And you can even do that within the S&P 500 tracking ETFs, right? Like SPY is more of a trading vehicle than IVV or VOO. And you're clearly seeing that those long-term holding vehicles continue to pull in assets. I think one thing you have to remember with ETF flows staying more consistent than mutual fund flows is that you're continuing to get a tailwind of folks transferring from mutual funds to ETFs. And I think every time over the last 10 years, where we've seen a significant disruption in the marketplace, where the whole market is down significantly, ETF flows actually pick up. And that's largely can be attributed to the fact that folks that were sitting on legacy long-term gains in vehicles like a mutual fund now have an opportunity to roll into a more tax-efficient ETF without the same consequences. And on top of that, you continue to have withdrawals out of 401ks, folks that are required minimum distributions. And as that money comes out, if they're not taking it and putting it to work, they want to leave it in the market, it flows out of that qualified money into a more tax-efficient vehicle like an ETF. So ETFs have really proven time and time again that when the market pulls back and people have an opportunity to reallocate, their choice is the ETF vehicle for its tax efficiency, its liquidity, and its lower costs.